I definitely think we're going to be higher. That's a simple one. How high? An awful lot depends on how this big geopolitical monetary reset, how rapidly that goes. But, my gosh, we could easily be knocking on 5,000. But the stocks, let's not forget, let's say gold goes to, you say 4,000, gold goes to 4,500, Well, at that price for gold stocks are going to be massively higher than they are right now.
Yeah.
Because apart from the increase in the valuation and everything else, that sort of price is just going to get more and more investors interested
the cash
in
flow
the
coming
sector.
out of these companies at that price as
So
well.
you see gold at 45 to 5,000, and you're going to see all the seniors are going to be easily double where they are now.
Gold prices keep rising, driven by strong central bank and investor demand. Adrian Day, a seasoned investment strategist specializing in precious metals, cautioned against predicting the exact timing for gold prices but expressed strong confidence in a significant upward trajectory. He emphasized that much depends on the pace of ongoing geopolitical and monetary shifts. Day suggested that gold could realistically approach $5,000 per ounce, and even a move to $4,500 would have a dramatic impact on gold stocks. He explained that at those price levels, senior gold stocks would likely surge well beyond their current valuations, driven not only by higher intrinsic value but also by the increased investor interest such prices would attract. As gold rises, the net present value of mining operations and their cash flows also increase, supporting higher stock valuations. Consequently, even after recent gains, big-cap gold stocks remain attractively priced, and Day believes there is still substantial upside potential ahead. Day also noted early signs of shifting investor behavior. By the last week of August, inflows of around $300 million appeared over 2 weeks, though year-to-date outflows still totaled $3.5 billion. He highlighted this as a clear signal that ordinary investors are beginning to turn toward gold, marking a meaningful change in direction even if it is still in the early stages. If you found this video valuable, be sure to like, subscribe, and share it with other investors who are closely following the gold market. We'll continue to bring you clear insights and expert perspectives on the trends shaping today's monetary and geopolitical landscape. Thanks for watching.
The senior stocks typically, not necessarily every single one of them, but the senior stocks typically are still good values with a lot of, and we're just talking stock price, not company, but stock price appreciation ahead of them. And I say that for two reasons. One is, even though the gold stocks have moved up significantly this year, the U.S. investor, the ordinary investor, the dentist in Oklahoma, or the registered investment advisor that knows nothing about it but is saying, I think we ought to have 2% in gold, or he's getting calls from clients. Yeah. These people have only just turned. They've only just started to turn, and towards gold. And you can see that very, very clearly in the flows into the GDX and the GDXJ. Until the last week of August, right? So all the way up to the middle of August, third week of August, you had massive and continuing outflows from the GDX. Just think about that for a second. The gold stocks are up 50, 60, 70%. Gold's at pretty much new all-time highs. The world's falling apart. But the GDX is seeing massive outflows. So as of last week, when I left the office, I don't know about today, but as of last week, you'd had 2 weeks of inflows into the GDX, amounting to about 300 million. And year to date, you've still lost 3.5 billion. Year to date, you've lost 3.5 billion in outflows from the GDX, which, when you think about it, is just mind. And so, again, I take that as an indication that the ordinary investor who's not a gold bug is only just turning towards gold. Now, 1 week, 2 weeks doesn't, one swallow doesn't make a spring or summer, right? Yeah. But it's certainly a change in direction, and a significant change in direction. So that's number one. Oh, and sorry, when the dentist in Oklahoma calls his registered investment advisor who knows nothing about gold and says, I think we should have some exposure to gold, what does the guy do? Well, he doesn't buy age expiration. If you look at their price to cash flow today, it's higher than last year, but it is lower than every single one of the last 5 years. So it's not overvalued, and you could do that exercise with, net present value and everything else. Now, I'm not suggesting the stocks are as cheap today as value. I'm talking value, not price. They're not as undervalued today as they were in January, but they're not as overvalued. They're not as overvalued as you would think, given the increase in the price of gold, because not only has the price moved up, but the thing we're measuring price against has also moved up. As the price of gold goes up, the net present value moves up, and the value of the mines goes up. As the price of gold moves up, the cash flow moves up. Right? So, no, the valuations are still very cheap. So, I think that big cap stocks are still going to, I don't think anyone's missed that. They're still got a lot ahead of them. Well, you know what they say, if you predict a price, don't predict a time.
Yeah.
And you tell me a time, so I'm not going to be...
Okay.
I definitely think we're going to be higher. That's a simple one. How high? An awful lot depends on how this big geopolitical monetary reset, how rapidly that goes. But, my gosh, we could easily be knocking on 5,000.
Yeah, I wouldn't be surprised.
Yeah,
at this
easily.
point. Yeah.
But the stocks, let's not forget, let's say gold goes to, you say 4,000, it sounds so conservative.
No, but it's $400 away now. Less, it's $350 away now.
Let's say gold goes to 4,500. At that price for gold stocks are going to be massively higher than they are right now.
Yeah.
Because apart from the increase in the valuation and everything else, that sort of price is just going to get more and more investors interested
the cash flow
in the sector.
coming out of these companies at that price as
So
well.
you see gold at 45 to 5,000, and you're going to see all the seniors are going to be easily double where they are now.
Adrian Day explained that many of the themes highlighted earlier in the year are now beginning to unfold. Back in March, he emphasized that gold's strength was largely driven by central bank accumulation, non-official Chinese buying, and other global demand, while North American investors had yet to participate. That lack of domestic involvement kept gold stocks lagging despite rising gold prices. He also noted that central banks remain the dominant holders of global reserves, but with the US dollar now averaging less than 50% of their assets, around 47%, the urgency to diversify has grown compared to when dollar holdings were near 75%. Day further observed that senior gold stocks continue to offer good value and potential for price appreciation even after significant gains this year. He pointed out that the broader US investor base, ordinary investors and advisors with little prior exposure to gold, has only recently started showing interest. Evidence of this shift can be seen in gold ETFs like GDX and GDXJ. Despite gold approaching all-time highs and stocks climbing 50 to 70%, these ETFs experienced massive outflows up until mid-August, signaling that mainstream investor participation is still in the early stages. Let's get back to the interview.
I think some of the things that we were talking about there, not just we, but people have been talking about, are finally beginning to play out. Because the big theme back in March, or my big theme back in March, I should say, not speaking for everyone, but the big theme there was, okay, gold is obviously doing well because of central banks, because of non-official Chinese buying and other sources, but the North American investor just isn't in the market, and because of that, the gold stocks are lagging. And we're beginning to see that narrative is definitely shifting. Now, we might come to it later. I still think that the gold stocks, even though this year, the last 6 months, they've had leverage over gold, the leverage is still less than you typically have. For example, if you look at gold over the last, 2 years, 18 months, it's gone up 40%. The last time gold went up 40%, the gold stocks were up 3.5 times that. This time they're up, 1.5 or 2 times. Yeah. So I'm certainly not complaining about the gold stocks being up 70 and 80% this year, but it's still, they're still not giving us the leverage that we're used to. And there's reasons for that, because North Americans, and we'll get into this, I'm sure, North Americans are only just beginning to get into this market. But it's also, when you look at the dominance of the dollar in central bank reserves, let's say at the beginning of this century, we were at like 75, 78, almost 80% of foreign reserve assets of all central banks was the dollar.
Yep.
By foreign, we mean if I'm the Bank of England, we're not counting pounds.
Yeah.
So everything else I hold. Well, that is extraordinary concentration. Forget whether it's the dollar or gold or Trump or forget all of that stuff. That is just extraordinary concentration to have 80% of your reserve assets in one currency, in one asset. If I did that in my fund, the S&C would be all over me. But and so I think when this is, and again, I know we mentioned this I'm sure we mentioned this in March. This is not something that just started this year.
Yeah.
With the current president. This has been a trend that's been going on for a long time, again, very slowly at first. So we went from, 75, let's just say 75% of foreign reserve assets in the year 1999. 5 years ago, probably 65%. Yeah. Well, for institutions like central banks that are so slow moving typically, that is a huge decline, especially when during those years, they were actually earning increased number of dollars. Yeah. So to reduce it was pretty astonishing. And then of course, what were we down to when Trump came in? We were at the end of last year, we were probably down to 55%.
Yeah, I think I saw a figure recently. I think it was around 52%, something like that. Yeah.
Yeah, the last number I saw was actually 47%, and it came from the ECB. But I don't know.
I mean, that's crazy, though.
I don't know if you can trust those people.
Yeah.
Foreigners, French as well. But I'm saying but you can see how it's accelerated. But to go from 75 to 65, 65 to 55, and then from 55, as you say, to 52 a few months ago, now to 47.5%, that's a dramatic shift. But so it's to me, it's even if you take away the weaponization of the dollar, which again has predated the current administration, been going on for a long time. But even if you take that away, it just is prudent to diversify. Yeah. And that's just added the extra impetus. Now, when does it stop? That's a big, I think central banks are still the dominant. So let's start there. Now, obviously, if you've got 47% of your assets in the dollar, and obviously it's more for some and lower for others, but if you've got, on average, less than half, well, the urgency is not as much as it was when you had 75%. But if the weaponization of a dollar is something that really concerns you, what's too much? I mean, it could be zero is the right number if you're really worried about them stealing your assets. Russia obviously has no US dollars, and they got out of US debt, 5 years ago. So for some countries, you need to be significantly below basically half your assets in the dollar. The World Gold Council just did a survey of central banks, you probably saw it, asking what they would be doing, and a significant majority said that they would be increasing their gold over the next 12 months. And I don't think was there anyone on that list that said they expected to reduce them?
Well, I mean, why would you?
So I do think the central banks are going to continue to be buyers. We're clearly now, with the economic shift and with the geopolitical shift, you've got added impetus, which is becoming apparent to people, yeah. Right? That's the thing, is not whether people like you and I and the intelligent people that it is your audience know about something. The important thing is it the dominant theme?
Yeah, yeah.
And I think that the shift in assets, global reserve assets, has become a dominant theme now that investors are paying attention to and wealthy people are paying attention to. And of course, it's not just for central banks, as we mentioned, but it's the Basel III, meaning that gold is a primary asset, So there's a lot of things that are just bringing gold back into a role in the world's monetary system.
gold continues to demonstrate its strength, driven by central bank accumulation, strategic buying from China, and growing awareness among North American investors. Despite significant gains this year, senior gold stocks remain attractively valued, with price-to-cash flow ratios lower than in most of the past 5 years, and with potential for further upside as both net present value and cash flows rise alongside gold prices. The gradual reduction of the US dollar's dominance in global reserves and the increasing role of gold in central bank portfolios, supported by regulatory frameworks like Basel III, underscore a broader monetary shift. As ordinary investors begin to turn toward gold, inflows into gold ETFs are starting to recover, signaling a growing recognition of its value. Looking ahead, gold prices could reach unprecedented levels, potentially driving senior gold stocks substantially higher and attracting a wider wave of investors, reinforcing gold's enduring role as a core monetary and investment asset. How could the shift in central bank reserves impact gold prices and gold stocks? Stay tuned. If you're interested in real, data-backed insights on the financial system, hit like and subscribe so you never miss our weekly updates. Thank you for your support, and we hope you enjoy the video.